Hi, everybody. Welcome back to Money Matters TV. My name is Steve Rosenberg from the GSD Group, philanthropic advisor and consultant to the not-for-profit community. Thrilled to be here again. Want to introduce you to my co-host for the week, Dan White. Dan White and Associates. Dan is a financial planner working with people, retired people and all people. You may have seen Dan on Fox or CNN or read some of his writings nationally. Dan is one of the great financial planners in our region. Dan, welcome to the show and nice to see you.
Good to see you again, Steve. Thanks for having me on.
Yeah, thanks for being here. So let's just jump right in, I guess, here and talk a little bit about what's going on in your world, which I know it seems to me, you and I spoke yesterday. I am not a financial planner, and I hire people like you. Give us a sense of the state of your world. What's going on today?
Yeah, I think from our perspective, with everything that is going on, people's greatest concerns right now are just having enough income in retirement. You know, the retirement landscape has changed significantly in the past 40 years. I mean, if you think back in 1980, we're complaining about high interest rates today. It's 5% and 7% mortgages. I mean, if you were buying a house in the 1980s, you were looking at 13, 14, 15%. So that from that perspective, back in 1980, everybody had pensions. Longevity really wasn't an issue. We weren't living as long back then. So people had a pension. They claimed Social Security at 62, and maybe they had a little bit of savings and their house was paid off. I mean, that was a pretty comfortable retirement. But, as we look at the world today, hardly any, unless you work for the government, pensions are kind of a thing of the past. I don't know of too many private companies that even offer pensions anymore. The bond bull market, I mean, interest rates have come all the way down from 15, 16%. They were zero for years. Now they're going up. So we know what happened last year. The 60-40 portfolio got destroyed. I mean, stocks lost 20%, bonds lost around 15%. So I think the big concern for people today is, where am I going to get this income in retirement? I mean, I got to plan on when I'm going to take Social Security, and most people, like I said, don't have pensions. So it's about positioning their assets to make sure they don't run out of money before they run out of life.
And what advice are you giving to your clients? Because I would imagine that's I'm reading a book now called Die with Zero, right?
Yeah.
I've heard of that book. And
Yep.
It's a very interesting perspective, right? Like, spend your money now, don't wait. How much do you die with? And I think, to your point, what you just said, people are worried. How are they going to have enough money? And nobody knows, obviously, how long we're going to live. And we want to make sure that we're able to live long and prosperous is obviously the key phrase. What advice are you giving to people?
Yeah, that's probably the I mean, nobody, I've had people come into my office and they're like, I hope my last check to the undertaker bounces. They don't want to die with a lot of money, but at the same point in time, people are afraid to spend their money because they're afraid they're going to run out. So I think what people really need and what we try to set up for people is an income game plan. You want to have income that's guaranteed to last as long as your life. And when you think about a pension, or an annuity for that matter, it's kind of funny when people come into my office, if I ask them about annuities, I usually get a negative response, because they've heard some bad things. If I ask them about a pension, I get a very favorable response, other than the fact that they wish they had one. And I said, well, they're really one and the same. An annuity, a pension is an annuity. So I said, even though your company doesn't offer you a pension anymore, you could take your 401k, you could take your IRA, and you could purchase an income annuity that would pay you the rest of your life. And there's a good chance, if you live a long time, that there wouldn't be any money left for the beneficiaries. But then again, even if you run out of money, you're still going to get that monthly paycheck for the rest of your life. So when you talk about dying with zero, these are the products that help you do that.
Yeah, and I guess if you're not careful and you're a big spender, you could live with zero. Now, there's a lot of people that are entering retirement seems like earlier and earlier, or certainly a lot more people entering retirement. A lot of people are not intuitive enough maybe to hire good, smart people like you, and let's call them do-it-yourselfers. You've been around for a while. What's the one best single piece of advice that you would give to those folks who might be tuning in?
Yeah, it's kind of scary because, people come in and they say, "Oh, I was through the dot-com bubble and I was through the Great Recession in '08." And the market always comes back, and we're getting toward that point. I mean, and then my first reaction is, yeah, but you were 25 years younger then, and time was on your side, and now you're 25 years older, and time is getting shorter and shorter. And you may not have the time to make up those losses that we could do 20 years ago. But the other thing to consider is, like I said, I think the bull market in bonds is kind of over. And let's face it, we can't count on the government keeping interest rates at zero for the next 20 years because, the other elephant in the room is the government debt and the deficit. At some point in time, that's got to have an impact. I mean, you look at, we're $33 trillion in the hole. So, I mean, and at zero interest, that was one thing. But now when interest rates are 5%, I mean, gosh, about 30-40% of our government spending is just to service the debt. So I don't think we've had a very good run, I would say, from 1980. Yeah, we hit a couple bumps in the road in the markets, but I really don't think for the do-it-yourselfers, you can't count on 10, 12%. Out of the market, or even 5 to 6 on your fixed income portfolios anymore. You're going to have to, kind of adjust the sails a little bit and prepare for maybe lower rates of return moving forward.
Yeah, and I don't see a balanced budget amendment coming through anytime soon, and you can't tell people to play the Powerball. That's not sage advice. So thank you for those sage answers. We have a question of the week comes in this week from Thomas Moreland of Philadelphia for you, Dan. And his question is this a good time to buy treasury bills? And if so, what is the yield?
Yeah, I would say it is a good time to buy treasury bills. I mean, as I just discussed, interest rates were near zero for the better part of 15 years after the Great Recession. And then, COVID hit, and they started to tried to raise them in 2018. Didn't work, and then COVID hit. They took them back to zero again. But the government printed so much money in the last 3 years that inflation got out of control, and now they're really trying to stuff that genie back in the bottle and to kind of put the brakes on inflation. So they've raised interest rates, from 0 to about 5.5% in 18 months. So yeah, today is a much better time to buy a treasury bill than it was even 18 months ago because interest rates are so much higher. Now, I know at one point, as far as yields go, they did tick above 5% briefly, I think about 2 weeks ago, but then they took about a 50 basis point hit in the last 2 weeks. So I think you're down in the 4.5 to 4.7 ranges on T-bills. But yeah, it's a risk-free investment. And if you can get close to 5% risk-free, we haven't seen that in a long time.
I agree. Now, if you have a question, here's how you can send yours in.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Welcome back. I'm super excited now to bring in our special guest of the week to join Dan White and I. To confuse you, our guest name is also Dan Berger, the CEO and president of Berger Communities, one of the nation's premier owners, managers, builders of multifamily housing around. And Dan Berger, welcome to the show. Glad to have you. Thanks for being here.
Great. Thank you, Steve. Thank you, Dan. Great to be here today.
So let's just jump right in. Dan, if you could give an overview and discuss the current state of the real estate market. Cannot be easy with interest rates high and costs high and demand high and low. And I know your properties well. They're first class building units. But how is the market right now? What are the conditions? Give our listeners a sense.
Yeah, really interesting question. So much going on right now in the real estate space. And I think it makes sense to take a step back for a second. Why are we in this situation? Well, real estate and interest rates correlate. Real estate values and interest rates correlate. For the last 10, 15 years, Fed's been reducing the rates, right? Close to 0%. This really happens every 10 years where we've seen interest rate reduction and then interest rates tick back up. And over the last decade or so, interest rates have been coming down. And what happens as a result? Inflation ticks up. The best way the Fed can curb inflation is by curbing housing costs. And what I mean by that is CPI, a core piece of CPI is housing costs. So the Fed's, landlords, especially in the multifamily space and the housing space, has had a target on their back for the last, year as the Fed is trying to curb inflation. So the Fed been actually pretty quickly increasing interest rates. And what's that do to apartments, to real estate, right? It drives up our cost of debt. So there's two different things going on here. One is just the capital market space, and the other is supply and demand for housing and general real estate. So first, with the capital markets, right, as interest rates go up, it's harder to borrow money, less liquidity in the marketplace, which in turn, right, reduces the ability for groups like us to go out and borrow funds. But in turn, right, values have come down. Real estate values in commercial real estate have dropped significantly. I would say values have dropped 10, 15, 20% over the last 12 to 18 months, while interest rates have come up. And what that means is a lot of owner operators have lost most or all their equity in deals, particularly those operators that have had floating rate debt. In the commercial space, you can have fixed rate debt, you can have floating rate debt. A lot of groups have chosen to have floating rate debt because, rates have dropped over the last 10, 15 years. And over the last 10, 15 years, if you've had floating rate debt, you made out really, really well. Well, now with rates increasing so quickly, those with floating rate debt went from, interest rates of 2% and 3% and 4% all the way up to, 5, 6, and 7%. Cannot make debt service. A lot of those floating rate debt, you've had caps on that debt that's expired. And what that does is results a big capital infusion as necessary by operators. So what we're seeing here is less liquidity in the market. Owner groups that have had owned properties for quite some time potentially lost a good portion, if not all their equity. And values in real estate and commercial real estate have absolutely come down. And we're seeing that. There's still a disconnect between buyers and sellers. Sellers still think there's equity or more equity in that deal than a lot of buyers. Cap rates have gone from a 5% cap rate to 6 to 6.5% cap rate, which in turn has reduced those values. I think this on is supply and demand for real estate. And I'm specifically, we're mostly, we do some retail, but 95% of the properties that we own and manage are multifamily. So in the multifamily space, there's still a housing shortage. Clearly, in the Northeast here and really across the country, we don't have enough houses, enough, apartments, enough houses. So clearly a shortage. And we've seen over the last few years, you've seen the headlines, rents have skyrocketed. And that's really what the Fed has tried to curb overall housing costs and rents. But supply and demand is still, there's still strong demand for apartments. We're really optimistic overall in the asset class, the multifamily asset class, because we think the fundamentals are really strong with such a housing shortage. With the increase in interest rates, increase in costs, there's a lot less development going on. I know probably a lot of people are still seeing jobs get delivered. And there will be some new projects being delivered over the next 6 months. After 6 months from now, that's really going to come to a halt. There's not many houses being built. There's not too many apartments being built. There's absolutely zero office buildings being built. There's not much retail being built. Everything is really stopped as costs have increased and interest rates have increased. So the housing shortage we have today is only going to get worse. There's going to be even a bigger housing shortage, and we're going to really see that in the next 1, 2, 3 years. So long term, I think multifamily is still an asset class we're really optimistic on. Right now, values are depressed. I think it's a great buying opportunity for buyers with equity and with cash ready to deploy, because compared to a year ago, everything's 10, 20, 30% off, while debt prices are still higher as well.
All right,
So Dan, one of the things, when I look at real estate and the real estate marketplace, I think there's two challenges in the residential. As you said, I don't think there's much of a supply because you've got homeowners, that locked in at 2-3% mortgages, and now even if they want to move, the cost of capital is so much higher. They don't want to lose the 3% mortgage and then lock in at maybe a 6 or a 7% mortgage on a new house. It's going to cost them a lot more. In the residential side, and even on the commercial side, my concern is, COVID hit, and a lot of commercial tenants realized, hey, we can work from home. A lot of law firms, a lot of businesses such as that, we don't need all this space. And now as these leases come up for renewal, and maybe they were locked into a 3% lease or something, now they're going to renew it 7 or 8. What are your thoughts moving forward? Do you see a lot of vacancies? Do you see maybe some defaults, maybe some banking issues? What do you see moving forward?
Yeah, that's a great question. I think there's different asset classes to look at. First of all, office. We have way too much office. There is going to be a lot of defaults. The office space is not going to recover. It's not going to get back to where it was. Class A office space is doing incredibly well. A+ office space in great locations is never done better. It's really the Class B and Class C office space that's taken a huge hit. I don't think it's going to come back. I think it's going to be a lot of defaults. It's a lot of big banks holding a lot of notes and a lot of paper on that, and I think they're going to take huge losses. I don't know the answer for that. A lot of this office, people talk about converting office to multifamily. It does not work in 95% of the buildings. This between the ceiling heights, elevator shafts, window configuration, it does not work. That conversion just does not work from office to multifamily in 90+% of the situation. Unfortunately, I think the highest and best use potentially of some of these buildings is to take them down. So there will be some losses. In the retail space, we're still seeing some pretty strong rental increases in the retail space. Retail is holding up really, really well right now. And same with industrial space. In the multifamily space, we are seeing increases settle down. So rental increase is absolutely settled down nationwide. Down south in some of the areas that were really, really hot 2, 3, 4 years ago, that saw 10, 15, 20% annual rent increases, that has definitely slowed down. And down there and down south, they're trying to maintain their current rent roll, right? Get away with a 0 increase and not lose occupancy. I would say up north in the Philadelphia area, in the Northeast area, we didn't see quite the same rental increases that other markets did. While they might have saw 10 to 20% increases, we saw 5 to 10% increases. We're still seeing an increase. We're still seeing 3 to 4 to 5% increase in rental rates, but we're not seeing what it was a year or two ago. We're also watching our collections really closely. So watching bad debt, watching collections, and we're really watching credit card payments. So, as we see credit card payments for rent increase, that is a leading indicator that we could have some collections issues down the line. When rents have outpaced wage growth, that's a problem. And we can, there's a housing shortage and we can continue to charge and increase rents. But if there's no place for people to move to, right, we can increase rents. But if they can't pay the rent, it does everyone disservice. So we're watching that really closely. To your original point, residential rates are obviously really high. Not many people are moving in that space. So it's very different in the commercial world where, our loans are mostly assumable and we can transfer those loans. They're either an asset or liability. On the residential side, there's not. So we're not seeing much movement on the home ownership side.
So Dan, it seems like every day you read in the business section or the business journals of the world that there are still a lot of people that want to be in the real estate space, particularly on the investment side. Maybe they're not going to build multifamily developments like you do, but they want to be in real estate investment. And real estate doesn't seem to ever get old. It doesn't go bad. And there's new players in the market every day. And there's people that come into our market because I feel like we've got a pretty good and stable market, whether they be investors from New York or whatever. So, and you see a lot of, new entrants into the market. So what do you look for? What investment strategies do you guys look for, or do you advise when people come to you when you go to invest in real estate? Like, what are some of the, low-hanging fruit ideas that people need to keep in mind when investing in real estate?
Yeah, it's a great question. I think a few things there. First, you're absolutely investing in a piece of dirt and bricks, right? But be careful who you're investing with. It's a lot has to do with, especially now with interest rates going up expenses going up, costs are going up. It's really good to invest with a professional operator. So I think that is key. Make sure you trust who you invest with and investing with a professional operator. Some of the key things that we look for when we're entering a new market or investing is first stability of the assets. So we want to own a property that we know will have stable returns. For us, that typically means locking in longer term debt because we have consistent cash flow. It means, making sure there's no deferred maintenance or limited deferred maintenance or deferred maintenance that we can clean up with a capital improvement plan. It means, what's the drivers in that market? And for us, the major drivers that we look for is education. We want to be in an area where there's good school district. We feel like if we have an apartment community in a solid school district, there will always to be demand for people that want to have kids that want to go to that school district. So first and foremost is what school district is that piece of real estate in, that apartment community in. Second is what are the major employers in that market? Specifically, with employers we really like are large universities. Large universities are not going anywhere. 10,000 students or more at that university. That means a stable university or college that's not going anywhere. That's first. Second is medical. Hospital systems, strong hospital system is a great employer base that's not picking up and moving. We also look for just major employers in the market. Careful. Some of those employers can jump really quickly, especially if they'll own the real estate. Some employers, they're just leasing space in an office building. That's really easy for them to vacate, right, once their lease expires. So we're looking for major employers that own their real estate in that market. And I would say lastly, it's income in that market. It's population growth. What are the drivers? How many more people are moving into that area? How transit oriented the property is, the walkability of the property. So there's a whole bunch of factors that we look at. But for us, we're looking at stability. This property, we want demand for this property over the long term.
Thanks.
Yeah. So Dan, when you look at how things have changed drastically, even in the last 2-3 years, I mean, I'm a big believer that COVID kind of just fast forwarded a lot of the changes that might have taken 10 years, and they compacted them into 2 years. Because people had to work from home, and as I said, a lot of these companies are saying, hey, why do we need 5,000, 10,000 square feet in Center City, Philadelphia, when everybody can work from home? So, how are companies, real estate companies, evolving given the current economic conditions and changes to the workforce? What do you see moving forward?
Yeah, that's a great question. I think there's a few different things there. For us on the multifamily side, we're making sure we're accommodating for those work from home folks. So we know that's reality. A lot of people are working from home. So we're making sure we have space for them to work from home, right? Either in their apartment or common space downstairs. If it's a Zoom room, or if it's community amenity space that allows people to work maybe in an area where they can work with other folks in the same room, but also private space. Is there little workstations, cubicles they could work in, so they can work from home without being in their apartments, right? They can work downstairs in a community room. At the end of the day, for us as an employer, it's a requirement to be in the office. We feel like we are in the real estate space, and when you're in the real estate space, it's important to actually work in the real estate. So we require 100% of our folks to be in the office. Culture is so important to us, and culture is really is our competitive advantage. Our team members really drive our customer satisfaction. Our customer satisfaction is what drives our success. So we're really big into having people working in the office, right? And our culture and overall company personality, and that we feel like will drive our customer satisfaction. And customer satisfaction drives long-term success of the business.
Thanks. We only have about 4 minutes left, and I want to make sure that we want to follow up on that because that's a very important point. Berger is known as having incredible core values and leadership. And to that point, Berger has started a not-for-profit called Hope and Door that I want to give you an opportunity to talk about, but also talk about how the leadership that you all have developed and adhere to each and every day led to the start of Hope and Door, and how you use that culture and the leadership and your commitment to philanthropy to instill those values throughout your team.
Yeah, thanks. So one of our core, values and fundamentals in the company surrounds itself with empathy. We look for empathetic team members when they join the company. We feel like empathetic team members, they want to help other people. They're great at customer service, giving back. is a core, philosophy of theirs, is helping out in their community. So empathy, we have a team of 300 here that want to help other folks, right? And that was really the impetus for launching our nonprofit called Hope and Door. It's a 501c3. It's a public charity, and its mission is to prevent family homelessness. So we see it firsthand. We see residents being evicted. And unfortunately, there's not much we can do about it because of fair housing laws. We have to treat every single person that rents an apartment the same. So we launched Hope and Door about 2 years ago. Hope and Door's mission, as I said, is to prevent family homelessness. And it's really the families that are being evicted at no fault of their own. So somebody, family potentially fell in tough times because a kid got sick, or they lost their job, or something tragic happened in their life, and now all of a sudden they are not able to pay their rent. Hope and Door kicks in, and they issues a grant on behalf of the family directly to the landlord to pay that balance of rent. Cleared criteria for when Hope and Door will step in. It's really, they'll pay up to 2 months of rent to a family that has consistent rental history for 12 plus months and have had stable housing. They have to have kids. So the hope is the Hope and Door can jump in, help that resident out, and that resident can stay living in that apartment community in their house for the future. We find there's such a correlation between the eviction. What happens to the eviction, especially the kids, is just awful. Often they have to be moved and change schools. And it's really hard to find another place to live once you've been evicted. So Hope and Door really wants to step in and prevent that. So one of my passions is really around how we can help solve this. There's a huge affordability issue going around the country, and we feel like we can help be part of the solution here with Hope and Door.
That's a great program that you have going on there, Dan. Just to wrap this up, one of the questions I have is, with Jerome Powell, the Federal Reserve Chair, saying we're going to keep interest rates higher for longer, like don't expect cuts anytime soon. How do you think this is going to impact like housing affordability and the shortage issue if interest rates stay elevated for some period of time?
Yeah, it's definitely going to have a profound impact. Housing is values are coming down. They have to come down with interest rates, with mortgage rates 7%. Values do come down. So I think housing, values will come down. People are going to lose equity, unfortunately. But this is not going to solve this. We ultimately need more households. We need to build more is the best way to stabilize housing costs. So more supply to match the demand, and demand's not dropping. So we need more supply, more housing supply.
Yeah.
Dan Berger, thank you very much. We could go on all day because, like I said, real estate is, to me, the opiate of the masses in so many ways, particularly in this area. And to talk about it in a financial way with Dan White, really incredible. So thank you for being here, Dan White. Thank you for co-hosting. Our next guest is going to be Scott Payne from Scott Payne Outdoor Group. You should tune into Money Matters whenever you can and wherever you can, because you're going to learn something about financial literacy, financial investing, and how to be better at your own finances, whether it be in real estate, retirement planning, or philanthropy. Thank you all for being here. Dan and Dan, great show. Hope to see everybody again real soon.